Bahnhof is an internet service provider in Sweden. It trades at a market cap of almost 6.7 billion Swedish kroners, or approximately 700 million US dollars. It has almost no debt, almost 10% of market cap in cash. The founder is still the CEO, and the two co-founders own 50% of the company. They pay most of the earnings as a dividend while still maintaining the possibility to grow revenues and free cash flows. It has a working capital advantage where most of the balance sheet consists of cash, prepayments, and receivables. In a nutshell, it has plenty of the ingredients one would look for in a potential investment. Bahnhof is a smaller player in the Swedish internet service provider market, going up against larger behemoths such like Telia, Tele2, and Telenor. It would seem difficult for Bahnhof to navigate in such a competitive market with established leaders, but they have carved out a niche and a very loyal customer base. They have low churn and grow slow and steady year after year. Customers are very satisfied, and Bahnhof is consistently named as the most popular of the internet service providers in Sweden. They have hyper focus on internet stability and efficiency, in addition to privacy. The financials of the company are very stable, and the company has yielded terrific returns for shareholders since going public. Bahnhof is a smaller player, but has also been able to make quite a name for themselves. In the early 2000s, the company became notable due to their hosting of WikiLeaks. Bahnhof has intense focus on their customers and privacy and are not afraid of standing up against pressure from public and media in order to defend their customers' interests. This backstory is important to understand the company's origin and culture. The CEO is quite a character and writes some amusing comments in the quarterly reports. With the growing focus on privacy and GDPR in society, as well as geopolitical tensions, I believe Bahnhof's history and the corresponding customer loyalty sets them up for continued success both in Sweden as well as for their upcoming international expansion. Looking at the financials, Bahnhof's numbers are remarkably stable. They grow revenues, gross profits, earnings and free cash flow at a steady pace. On a chart, it looks almost like it's drawn in a textbook. The 7-year CAGR in revenue growth has been around 10%, and for earnings it has been 15%. Return on equity and return on invested capital is consistently around 30%, and there is no reason why this should change. They produce a lot of cash, which they build up on the balance sheet. I believe they will make bolt-on acquisitions in other European countries to build up a presence in other markets. They recently did this in Norway. However, if it weren't for the saturation in the Swedish market, then the company would have the ability to grow without retaining earnings. Investments in property, plant and equipment is modest, and free cash flow largely follows the earnings. These are features that I deem most important when owning companies over the long term. Now the revenue growth has been slower and slower over the last years as the company has grown larger. Last 3 years revenue growth has only been around 8% each year. With a bit of margin expansion, the earnings growth has still been pleasant reading. However, for the year of 2024, earnings only grew 2% and the growth story seems to have met a bit of a plateau. This is why the company is looking abroad to find more growth. If this investment should yield a better than market return, you have to believe in the international growth story. They will grow in Sweden, both with private and commercial customers, both in volume and in price. Before the current valuation, you need additional growth from international markets. The modest growth in earnings per share last year was largely due to an increase in financial income. This means that earnings were basically flat if you strip out the effects from the high cash position. Margins are a bit under pressure and will continue to be so in the coming quarters. One could therefore say that the company is under-earning at the moment, but these investments are necessary to increase future growth. Belief in international growth is needed to make the investment worthwhile, in my opinion. Now, if you have listened to the first episode of this podcast, I explained why international expansion from Sweden to countries like Norway, Finland, and Denmark is not as scary as it may sound. The Norwegian market in particular would much welcome increased competition in this space. Bahnhof is used to providing its services at low cost and will be able to build a market position for cheaper pricing than the larger whales in the Norwegian market. I'm positive when it comes to the international expansion, and many Swedish companies had great success in Norway. Bigger markets such as Germany is also a target for Bahnhof, which will be more difficult to access, but an obviously much higher potential reward. To sum up the situation, we have a profitable and stable company of high quality which is founder-led, They have experienced some growth hiccups in the last few years due to saturation of the Swedish market. In the Swedish market, one can expect them to grow high single digits in terms of revenue. I don't foresee a margin expansion, so growth in earnings and free cash flow will be approximately the same as revenue. Now, this was the situation for the Swedish market. In order to get a market-beating return of around 15% each year, one has to believe in the international expansion. This is due to the multiple that the market has put on the stock. The multiple is currently 30 times, corresponding to a yield of 3.3%. With this valuation, I would prefer to have confidence in growth in the region of 12%. I currently do not have confidence in this growth, despite being very positive in the international expansion. As a consequence, I want a 15 to 20% haircut in the valuation before diving in. As many has probably experienced a couple of times, multiple compression is the killer of long-term returns. Let's say that Bahnhof grows earnings 15% each year over the next 5 years. This would be great growth and a double of earnings. If you over the same time get a multiple compression from 30 times to 20 times earnings, which would not be unreasonable, the total return, not including dividends, would only be 6% each year. If the multiple goes from 30 to 15, the total return would be 0%. The example shows that the entrance multiple in a stock is very important, and 30 times earnings for Bahnhof at current growth and profitability is simply too high. If you want to pay 30 times earnings for a company, you need a high degree of certainty of solid long-term growth. So why is Bahnhof trading at 30 times earnings? I think the market is possibly overestimating the near-term growth, or perhaps underestimating the margin pressure, which will continue or maybe even increase in the coming quarters. I currently do not own shares in Bahnhof, but will keep a keen eye on the company going forward. The possibility of me owning the company in the future is large because of the qualitative aspects that I have touched upon. Thanks for listening.